Good morning, everyone, also from my side. It is my pleasure to welcome all of you to the public event Proportionality. I am Jacopo Coccoli, expert on supervisory convergence at EIOPA, and I will accompany you through the event today. I will first share a few slides on the housekeeping rules for today. I wanted to inform you that the event will be recorded, and okay, so the event today will be recorded, and the video will be published on the EIOPA event website. All participants will have the possibility to submit questions, but in case you don't want your name to appear publicly, you can also submit anonymous questions. To ensure that we can experience a smooth event today, all microphones and cameras are not active for all the participants. In case you are kicked out, you can rejoin or refresh the session, and you will be able to rejoin the event at any time. Regarding the Q&A session, we welcome questions during the event. You will find in the Microsoft Teams application a Q&A button on your screen. You can then submit your question, and once the question will be accepted, you can also upvote in case you want to highlight the question submitted by other participants. We expect today very high numbers of participations. Therefore, we will strive to respond to all the questions received, but in case this will not be possible, rest assured that we will also keep the questions for future reference in our work. Now, moving to the agenda for today. As we just heard from our executive director, the recent review of Solvency II is considered as a core milestone in making the insurance regulation more proportionate and risk-based. The new proportionality framework is a key element of this review, and it strikes the balance between ensuring practical simplification for eligible undertakings while preserving the supervisory objectives and the policyholder protection. In today's event, we aim to analyze the framework from different angles. We will hear about the policy objectives that were behind the reforms, the development of the regulatory framework that the EIOPA actively contributed to, and also we will have key insights from representatives from the national competent authorities on practical examples on how the framework is being implemented ahead of the entry into application. Without further delays, we can get started. We scheduled two insightful keynote speeches regarding the new proportionality framework. I'm now pleased to welcome Mark Horowitz, which is Deputy Head of the Insurance and Pensions Unit at DG FISMA, the Directorate General on Financial Stability, Financial Services and Capital Markets Union at the European Commission. Mark, we will deliver a speech on simplification and burden reduction in uncertain times. And therefore, Mark, the floor is yours.
Thank you, Jacopo. Can you hear me well?
Yes, great. Very well.
So thank you for inviting me today and giving me the opportunity to speak with you today. And thanks in particular for giving me the opportunity not to debate about volatility adjustment or long-term equity, which will be quite a refreshing exercise for me. When we look around us, uncertainty seems to have become the defining feature of our time. Geopolitical tensions, cyber threats, climate risk, demographic change, technological disruption, and the increasing fragmentation of the global economy are reshaping the environment in which insurers, pension institutions, and supervisors operate. And at the same time, Europe faces an immense investment challenge. The Draghi report has reminded us of the scale of investment needed to strengthen Europe's competitiveness, support innovation, finance the green and digital transitions, reinforce defense capabilities, and enhance our economic security. The Savings and Investments Union is built around a similar ambition, ensuring that Europe's considerable pool of saving can be channeled more effectively towards productive investment opportunities. Insurers and pension funds have a crucial role to play in this endeavor, as they are among Europe's largest long-term investors. They provide resilience to households and businesses and can make a significant contribution to financing Europe's future. But to fulfill this role effectively, they need more than capital. They need a regulatory framework that is robust enough to preserve confidence, predictable enough to support long-term investment, and proportionate enough to allow firms and supervisors to focus on what matters most. And this brings me to the topic of today's discussion: simplification and burden reduction in uncertain times. And let me start with a simple observation. Simplification is sometimes misunderstood. It is occasionally portrayed as a call for deregulation, as a weakening of safeguards, or as a trade-off between resilience and competitiveness. I do not believe this is the right way to look at it. In fact, I would argue this is the opposite. In uncertain times, simplifications becomes more important precisely because resilience matters more. And the reason is concrete. Supervisory and management attention is a finite resource. Every hour spent complying with a requirement that brings limited prudential value is an hour not spent identifying emerging risks, strengthening internal control, or improving risk management. And when risks multiply, the cost of that misallocation rises. Complexity is therefore not simply an administrative burden. Complexity itself can become a source of risk. Complexity consumes resources and absorbs management attention. It creates implementation costs and can divert efforts away from genuine risk management towards compliance exercises that provide limited prudential value. Therefore, good regulation is not about asking for more. It's about asking for what matters. Resilience does not automatically increase with the volume of regulation. A larger rulebook does not necessarily produce a safer financial system. Resilience depends on our collective ability, supervisors, regulators, and industry, to concentrate our efforts on the risks that truly matter. And this is why simplification is not merely an administrative exercise. It is a prudential objective. It is a supervisory objective. And ultimately, it is a resilience objective. This philosophy has increasingly shaped the Commission's work in recent years. And let me take Solvency II as an example. The Solvency II review was not only about strengthening resilience or supporting long-term investment, although that latter topic I know is dear to the heart of many people connected today. But I have to say, the review was also about fundamentally rethinking the role of proportionality. For many years, proportionality was often discussed as a principle. A principle is valuable, but principles alone do not always change behaviors. Today, proportionality has become a concrete design feature of the framework. Perhaps the most significant change introduced by the review is not a specific calibration or technical adjustment. It is the recognition that proportionality should no longer be treated as an exception. It should be embedded into the architecture of the regime. And the creation of a dedicated framework for small and non-complex undertakings reflects this shift. Reporting requirements have been substantially streamlined, and on governance, the framework now takes a more differentiated approach, one that acknowledges that not every undertaking faces the same operational complexity. In other words, proportionality is no longer treated as a derogation from the rule. It has become part of the rule itself. Most importantly, the review changes the burden of proof. A company that meets a limited set of objective criteria gains automatic access to the proportionality measures embedded in the framework. And this is a very important shift. Because firms no longer need to demonstrate case by case that proportionality should apply. The framework itself recognizes that from the outset that different risk profiles justify different supervisory requirements. At the same time, proportionality cannot be reserved exclusively for one category of insurers. Risk profiles do not always follow size, and this is why the framework continues to allow all undertakings to seek proportionality treatment where justified by their circumstances. Proportionality is therefore not about creating two supervisory regimes. It's about ensuring that a single prudential framework can accommodate different business models without compromising policyholder protection. Let me also be clear about where proportionality stops somehow. The framework applies to the frequency and granularity of reporting. Proportionality applies to governance arrangements. Proportionality applies to the organization and intensity of supervisory processes. But it does not alter the prudential foundations of Solvency II. It does not affect the solvency capital requirement. It does not affect the market consistent valuation of liabilities. It does not affect the protection of policyholders. Those are the foundations of the regime, and they are not on the table. Proportionality, I would say, calibrates the burden, but it does not lower the bar. And proportionality must remain predictable and transparent. And this is why in the delegated acts of Solvency II, the Commission has sought to constrain supervisory discretion through objective and clearly defined conditions for the application of proportionality measures. This enhances legal certainty for undertakings while ensuring a consistent application across member states. Let me now turn to one of the areas where simplification can make the most tangible difference: supervisory reporting. Over the years, reporting requirements under Solvency II have expanded considerably. New templates were introduced, new data points were added, new reporting needs emerged. And each individual addition often appeared justified, but their cumulative effect has been significant. And today, many undertakings devote substantial resources to producing supervisory data. Supervisors, in turn, receive an unprecedented volume of information. But this naturally raises an important question. Are we always collecting the right information? Because good supervision depends on data, that's sure. But good supervision does not depend on collecting as much data as possible. It depends on collecting the information that genuinely improves supervisory judgment. More data does not automatically mean better supervision. Sometimes it simply means more data to process. So our objective should therefore be not to maximize the volume of information, but to maximize its value. And in this regard, the Commission has set a clear target, a reduction in reporting obligations of at least 25% across all sectors and 35% for SMEs. And EIOPA's recent work on the implementing technical standard amendments for the supervisory reporting and public disclosure reflects precisely this ambition. Reducing reporting, however, is not simply about deleting templates. It's also about avoiding duplication. Too often, the same information is requested several times by different authorities, through different reporting channels, using different formats. This is inefficient for firms and for supervisors. This is why EIOPA launched a public consultation earlier this year to identify overlaps, inconsistencies, and opportunities for streamlining reporting. And I think this is the right direction, and it's a clear direction. Collect data once and use it as many times as necessary. The same philosophy underpins the Commission's broader work on supervisory data. Earlier this year, the regulation on better data sharing between European financial authorities entered into force. It enables the European supervisory authorities, the ESRB, the Single Resolution Board, AMLA, and the European Central Bank to share supervisory information whenever they are legally entitled to access the same data. The principle is straightforward. If public authorities already possess information, firms should not be asked to provide it again. The same principle, collect less but use it better, runs through our work on sustainable and sustainability reporting. Through the omnibus legislation and our work with EFRAG, we are seeking to focus reporting requirements on information that is genuinely useful for investors and supervisors. Not every data point has the same value. Some are essential, others have a little incremental insight while generating significant compliance costs. Simplification therefore requires us to be selective. The objective is not less transparency, it's better transparency. Not more reporting, but better reporting. And simplification doesn't stop when level 1 legislation is adopted. In many respects, that is where the real challenge begins, because every delegated act, every technical standard, every guideline, every reporting template, each may appear justified when considered individually. But together they can gradually recreate the very complexity we are seeking to eliminate. Complexity rarely arrives all at once, it accumulates. And this is why simplification must remain a guiding principle throughout the entire regulatory cycle. It is not only about reviewing existing rules, it's about exercising discipline before introducing new ones. And sometimes this means deciding that a measure can wait. Sometimes it means recognizing that supervisory and industry resources are better devoted elsewhere. Choosing not to regulate immediately is not a sign of inaction. It is often a sign of prioritization. And this is precisely the approach that the Commission has taken, including with a number of Solvency II Level 2 mandates. The Commission, in consultation with the European supervisory authorities, decided to sequence several mandates, including 3 mandates related to Solvency II, so that supervisory and industry resources could remain focused on the highest priority. We therefore deprioritize the regulatory technical standard on sustainability, risk management plans, on exceptional sector-wide shocks, and on prudent deterministic valuation. Those technical standards will not be adopted before October 2027. And this decision was not about lowering prudential standards. It's about sequencing reform sensibly. Regulatory capacity is finite. Supervisory capacity is finite. Industry implementation capacity is finite. So good regulation, therefore, requires prioritization. Every new requirement, in particular when it comes to delegated acts, should answer a simple question. Does it create sufficient prudential value to justify the additional complexity or requirements it imposes? If the answer is no, then delaying that requirement might be the right regulatory choice. But knowing when to pause is one form of flexibility. But uncertain times also demand the ability to respond quickly when circumstances change in ways no one anticipated. After all, uncertainty is precisely about facing events that cannot be fully anticipated. The real test of a framework is therefore not whether it anticipates every contingency, but whether it can respond effectively when the unexpected occurs. The COVID-19 pandemic illustrated this clearly. During the crisis, supervisors rightly redirected their attention towards the most pressing risks. EIOPA responded pragmatically by postponing certain reporting deadlines, allowing insurers and supervisors to concentrate their efforts where they were most needed. That flexibility proved highly valuable, but it also highlighted that the legal basis for such adjustments was not always sufficiently explicit. The Solvency II review addresses this. It provides a clearer legal framework for adapting supervisory requirements in exceptional circumstances. This enhances legal certainty while preserving supervisory flexibility. This is an important combination. Predictability and flexibility are often presented as competing objectives, but in reality, good regulation requires both. Firms need predictability in normal times, supervisors and firms need flexibility in exceptional times, and a resilient framework provides both. This brings me to a few final thoughts. Simplification carries a paradox of its own. Even a change that lightens the regulatory framework is still a change. It has to be implemented. Systems need to be adapted. Processes need to be reviewed. Staff needs to be trained. Simplification itself, therefore, comes with implementation cost. This means that we should be just as disciplined when simplifying regulation as when introducing new requirements. Predictability is itself a public good. For insurers, it supports long-term planning. For supervisors, it supports consistent implementation. And for investors, it supports confidence. Constant change, even when well-intentioned, has a cost. This is why every regulatory change should have to earn its place, whether it introduces a new obligation or removes an existing one. The same question should always be asked. Does it improve outcome? Does it strengthen resilience? Does it create sufficient value to justify its implementation cost? If not, we should think twice. The objective of simplification, again, is not to lower standards. It's not to weaken resilience. It's not to reduce policyholder protection. The objective is to make regulation more effective by allowing firms and supervisors to focus their efforts where they matter most. Because in an increasingly uncertain world, resilience will depend not only on the strength of our rules, but also on their clarity, on their proportionality, on their predictability, and on their capacity to adapt where circumstances change. Good regulation is not measured by the number of pages we produce. It is measured by the confidence it creates, by the resilience it delivers, and by the risks it helps to prevent. Strong rules where necessary, simple rules wherever possible. That is not only the direction of travel for Solvency II, it is the direction in which the Commission as a whole intends to shape financial regulation broadly. Thank you very much. Back to you, Jacopo.
Thank you very much, Mark, for clearly underlying the importance of striking the right combination of effective regulation, flexibility, and simplification as a way to thrive in uncertain times. And it will transition us to our second keynote speaker, Giovanni Rago, head of the Supervisory Convergence Unit at EIOPA. Giovanni will present the EIOPA initiatives on proportionality, simplification, and burden reduction as a way to support supervisors and the market participants in implementing the revised framework. Giovanni, over to you.
Okay. Thanks, Jacopo, and good morning, everyone. I hope you can hear me well. Yes, I will start with an overview of the number of insurers operating in Europe and the trends over the last year, just to set a bit the scene. Then I will move to the reason why Solvency II has been reviewed. We are almost at the end of this journey, but good to remind you the reason that triggered the review. I will touch upon specifically on two topics. The one is the new framework on proportionality. That is, of course, the leitmotif of our event today. But I will also then spend a few minutes on the reporting streamline that Mark already referred to. And then I will close with a few final words on other EIOPA initiatives in the area of the simplification and burden reduction, and to share with you how EIOPA is contributing to the simplification agenda. But let's get started with some basic numbers. So the blue line in this graph indicates basically the constant decrease of the number of insurers in Europe, starting from 2017, so 1 year after the entry into force of Solvency II, until 2025. And you can see that we have 324 undertakings less in over this period, corresponding to a reduction of 13%. And if we see the red line, we can see that this downwards trends is even more pronounced for small insurers, because the reduction is 17%. Small insurers are, for the purpose of this slide, just the insurers that have a balance sheet less than 1 million. So I'm not referring to the small and non-complex undertakings, because we don't have such a long data series for this new category of undertakings. But we will see later the number of the small and non-complex undertakings. If we see the volume of the business, actually we can draw a different conclusion, that despite the reduction in numbers of insurers operating in Europe, the volume in terms of total assets the insurer manage is increasing. So it's almost 20% more. There is an effect also deriving from the fair values of the total asset that are measured and reported, but clearly there is a clear trend in the consolidation of the insurance market. But if you see the small graph on the left-hand side at the bottom, you can see that this trend is not happening only in the insurance sector, but it's something that we are observing also in the banking sector. So we can conclude that insurers and banks have increased their domestic and also cross-border acquisition to seek to reduce their cost, operational cost, compliance cost, also the challenge, the opportunity to invest in AI, cyber security may justify these trends, because they need to seek for economy of scales and efficiency. So on the one hand, this is a good news to some extent, because we have larger players that can better compete with international players. But there is always another side of the coin, because at the same time, it's clear that small and medium entities face higher compliance costs. Solvency II, it's a very modern, risk-based, advanced framework, as Daniel just reminded us. It's a sort of inspiration for many jurisdictions, but it's a complex framework. So it's important that the regulation remain proportionate. It doesn't create disadvantages for small insurer. That's why it's important to make sure that the principle of proportionality works effectively. And we will see in a few minutes what EIOPA did in order to improve this thing. But let me remind also briefly the reason for the review. I think we can say that over the last year, Solvency II worked well. We have seen a number of stress, a number of external shocks, like the very low and prolonged low interest rate environments. We experienced the challenges of the COVID pandemic that Mark also reminded before. But we can say that the sector remain resilient because on average, over the last year, the Solvency II ratio was on average 2 times the minimum. But anyway, framework to remain effective should also remain fit for purpose, so should be reviewed and up to date. That's why a European Commission sent a letter to EIOPA in February 2029 requesting EIOPA to provide some technical advice to fine-tune some aspect of Solvency II. The main reason for the review were four, basically, as you can see in the slide. The first reason was that there was a clause in level 1 requesting to review some aspect of Solvency II by the end of 2020. The process then took a bit of more time because of also this external factor that I mentioned, but as I said, we are almost at the end of the process. The second reason for reviewing Solvency II was to support the broader European policy priorities in terms of the capital market union, the Green Deal, and also to allow insurer to play their role as the largest institutional investor to invest in long-term assets and also to finance the real economy while, of course, maintaining policyholder protection. The third reason for the review was, as I said, to fine-tune the prudential framework in light of experience of the very low and even negative interest rates. So the calibration were not fit for dealing with negative interest rates, but also to improve, let's say, the supervision of cross-border undertakings, to have a better coordination between the home supervisor in the state where the undertakings is authorized, but also with the host supervisor that in the country where the undertakings is basically providing coverage. With also more central role of EIOPA. And I would like to remind you that the materiality of cross-border business is increasing in Europe because approximately 12 or 13% of the total gross written premium in Europe are underwritten by cross-border undertakers. So we are talking about roughly 200 billion euro and more than 800 undertakings. So it requires an effort on coordination. And then the last but not least, the fourth reason was to improve, enhance the principle of proportionality. As I said, we are almost at the end of the process because we have the directive, amending Solvency II directive that was published in December 2020, in January 2025, following the advice that EIOPA provided in December 2020. Then we have completed also the second level with the Commission delegated regulation that were published in February 2026 in the official journal. And we are about to complete the third level with about 50 technical standards, guidelines, new guidelines or revised guidelines, additional report to complete the framework in order to go live with the first time application of the review of Solvency II in January 2027. But let me now focus on two aspects of the review. As you can see in the slides, there are 7 main areas where Solvency II was reviewed. So the proportionality, fine-tuning also the long-term guaranteeing measures, encouraging insurer to invest more in long-term investments with a better calibration of risks. Then also the macroprudential tools was an area that was enhanced. The management of sustainability risk was also an area where Solvency II was reviewed. The reporting reduction, and finally, as I mentioned before, the cross-border business. I would start with the new proportionality framework. We will hear many times today in the course of the morning the new framework, but I would like to give you a snapshot of how the new framework will work. So why we decided to amend? Actually, proportionality is already embedded in Solvency II. There is a principle requiring that all the legal requirement, but also the supervision by the national supervisory authority should be tailored considering the nature, scale, and complexity of risk embedded in the balance sheet of insurer. But this principle, that is just a few lines, is considered by many stakeholders who provided feedback to EIOPA too wide, too judgmental, too difficult to implement in real life. And this led actually to a minimum of at least, I would say, suboptimal use of proportionality. If you read the statistic that the EIOPA published, for instance, on exemption or limitation from reporting, it's not a surprise that to see that not all authorities are making use of this possibility. That's why we advise Commission to change Solvency II. How we did it? Basically introducing a new level of undertakings, a new category that of so-called small and non-complex undertakings and groups. And we operationalized the principle with very simple, mainly quantitative criteria, but with also qualitative criteria, in order not to have any, let's say, any doubts anymore on whether the undertakings is eligible to benefit of proportionality or not. It should be crystal clear because there are some simple ratios based on some quantitative indicators. The framework also provides a very clear list of all the proportionality measures that are possible. And also the process is much simpler. It's not an authorization process. We call a notification process. Of course, the supervisor has a final say, but there is a reversal of the burden of the proof, because if the supervisor is of the opinion that the undertakings does not meet the very objective criteria, the supervisor will have to explain the reason why. But proportionality, it's a broader concept that is not limited just to small, less complex insurer. In principle, could be also possible that a medium-sized undertakings can benefit of proportionality. That's why there is the second way to use it for undertakings that are not meeting the requirement for small and non-complex undertakings, but in this case, is necessary a more, let's say, deep dialogue with the supervisor and a formal approval process. The condition to benefit of proportionality for non-small and non-complex undertakings are also defined in the Solvency II framework, in the delegated acts, and there will be a specific slot during this event today to look at the conditions. And finally, there are also some simplified conditions that are applicable for captives undertakings. EIOPA published also a technical paper with all the with all the detailed specification on how to calculate the criteria, just to have an harmonized convergence application of the framework. We will see this also later. But allow me also to spend a few words on the other area that is relevant for today's discussion, that is the reporting reduction. Mark already alluded to it. Starting with the narrative reporting, as you know, two different solvency and financial condition reports were introduced. One for policyholder, that is a shorter document with just a few pages on the main information, and then a longer report available for market professional, for investors. The other news that actually is not really a news is the external audit of the balance sheet, of the Solvency II balance sheet. It may look like a new requirement, but actually it's something that is already in practice in several member states. But moving to the core part of the quantitative templates, EIOPA published the draft ITS amending the reporting requirement in March 2026, and we are waiting for the final endorsement of the ITS, but there are several important proposals in the ITS. I would start also with the, let's say, necessary changes that were necessary to implement the changes from level 1 or level 2 on the long-term guarantee measures, the long-term equities, but I would say that are minor adjustments needed to be to reflect the changes. We on purpose introduced a very limited set of new information. Of course, when there are emerging risks, it's important also to reflect this in the reporting in order to give the supervisor the chance to collect the necessary information, but we intentionally limited the new requirements on pensions data that are data already reported to ECB, so to some extent are not actually new requirements, and also very limited information on the NatCat. And we proposed quite a number of streamlining. For instance, we reduced the quarterly templates. Then the information, the templates on MCR is only annual, is no longer quarterly. The same for the look-through information that applies on a semi-annual basis, so it's not longer required in Q1 and Q3. And quite a number of relief also for small and non-complex undertakings that have to report in Q1 and Q3 just one QRT, and for the rest they are exempted. We also deleted annual templates, 10 annual solo templates. I will not mention all of them in the interest of time, but this is just to share that when we started the work and discussing with our supervisor, we were not so convinced, so sure that we would have achieved this outcome, also because in 2023, I have already streamlined the reporting exercise, but I must say that after a long, fruitful discussion with supervisor, really exchanging views on the templates that are actually used on a regular basis, basically, we managed to reduce 26% of the number of quarterly templates, 30% of number in annual templates. If we count the volume of information reported in the data points, the information cut are 22%. And for small and non-complex undertakings, you can see that the percentage is higher, in line with the expectation of commission of 35%. And the cut is in particular 36% for the quarterly templates and 44% for annual templates. I would close with a final words on what else EIOPA is doing to contribute to the simplification agenda. Still in the area of reporting, it's worth reminding that we also increased the threshold For the financial stability reporting that large group have to submit, so the threshold was increased from 12 billion to 20 billion, so much more than the inflation observed in the last year. And this will lead to a reduction of 24%, 53% of respectively group and solos. Then on the Solvency II guideline, we are working in order to amend the guideline to adjust the changes from Solvency II, but we took the chance of this review to streamline the guidelines that are no longer needed because are well reflected in the market practice. We worked in two different batches. So overall, we propose to delete 160 guidelines out of almost 500 guidelines. So it's 32%, and we decided intentionally not to issue any new additional documents and guideline. I already mentioned the technical specification document to support a convergent application of the new framework from day one. We are taking into account proportionality in all policy files dossier that we have to deliver. So on IRD, DORA, sustainability, risk, retail investment strategy, we are making sure that proportionality is well reflected. Also, an initiative on the financial stability area. So we decided to postpone the European-wide bottom-up insurance stress test exercise that was originally scheduled for next year. So 2027 will be the year of the transition to IRD, the review of Solvency II. So we decided not to bother the industry with the new the stress test exercise that is postponed to 2028, and the same also for the IOP stress testing. And finally, to close, we are also reflecting a bit internally how we can be more agile, more efficient in our internal organization, in our internal working group to make the best use of our time. And with that, I think I can close my intervention and pass the floor again to you.
Thanks a lot, Giovanni, and I believe you offered a very tangible overview on how EIOPA continues to deliver the simplification and burden reduction objectives into Solvency II. It's now time to slowly move from the more general policy perspective to dive into one of the concrete initiatives on simplification and burden reduction, which is the introduction of the new framework on proportionality. In the next sessions, we will focus on two main areas: the framework applying to small and complex undertakings and groups, and also the part of the framework that is intended to be applied to undertakings and groups that do not classify as small and complex, but can still benefit from proportionality. We already went through many of the concepts, introductory concepts regarding proportionality. So I apologize in advance if I'm going to repeat some of the concepts that our previous speakers touched upon. But the principle of proportionality is already embedded in Solvency II and developed through different dimensions. Proportionality is embedded in the part of Solvency II that allows small insurers to be exempted from the application of the directive. it is embedded in the development of the supervisory review process. It therefore rules how supervisory activities should be tailored to the insurer's scale and complexity. And it also applies in the form of soft and regulatory requirements. It means that proportionality applies throughout the three pillars of Solvency II and in the normal development of the supervisory review, the review process. And you can see here some of the concrete examples on how proportionality is already applied. However, as Giovanni already reminded us, the review of Solvency II introduced a new framework that aims to increase the clarity and predictability in the application of proportionality for smaller insurers with several features. It means that the new framework is risk sensitive, enhances the supervisory dialogue between the undertaking and the supervisor, and it also grounded on the reversal of burden of proof. Key features of this framework are increased thresholds to allow further small insurers to be exempted from the application of the directive. A new category of small and complex undertakings and groups that can be identified on the basis of qualitative and quantitative criteria. A new notification process that introduces the concept of reversal of burden of proof, where the small and complex undertaking notifies the supervisors, and unless of objections from the supervisor, it can apply proportionality measures. An approval process for insurers that do not classify a small and complex one, allowing them to apply a limited set of proportionality measures. A monitoring system and an enhanced communication between undertakings and supervisors regarding the application of proportionality, and a list of proportionality measures that is identified in advance by the framework. With that in mind, we can then focus now on one of the key elements of the framework, which is the small and complex undertakings. And I will give the floor now to Johannes Baker, which is expert in the on supervisory convergence at EIOPA. And Johannes will provide us with an overview of the regulatory framework and present also the recent EIOPA document containing technical specification on the calculation of the small and complex criteria. Johannes, the floor is yours.
Should I share the?
Yes, it's better for you.
Okay, thank you very much, Jacopo, and good morning also from my side. I hope we have an interesting and non-complex time together on this SNCU and SNCG framework. And as Giovanni and also Mark indicated or referenced already in their interventions to a list of indicators to a new category of undertakings, I will try to answer at least some of the questions that you have after their speeches. And these are what are actually SNCUs, how this list of predefined criteria looks like, how is small and non-complex defined in Solvency II, and also what are the benefits or the proportionality measures that SNCUs and SNCGs can use. And for this, we really get into the topic. So, and as we already said, so SNC is a new category. One could also say SNCUs are the new kids on the Solvency II block that have access to a wide range of proportionality measures after fulfilling certain qualitative and quantitative criteria. So this is how Solvency II defines small and non-complex. And regarding the qualitative criteria, depending on the perspective and how you read them, one could also see them as an exclusion criteria. So, for example, undertakings that are pure reinsurance or use internal models to calculate their SCR, they are always considered complex and they can never become small and non-complex. And then moving from the left to the right side of the slide. So based on this remaining pool of undertakings, if an undertaking complies with an overall a set of 9 quantitative criteria over the last 2 financial years, it can become small and non-complex. But I have to say that also this, or the exact list an undertaking is assessed against depends on the nature of the risks an undertaking is facing and also on the business that it underwrites. And also in the interest of time, I will not really unbundle what can be considered small or what is considered more non-complex, but you see all the indicators, they really range or try to cover the full Solvency II framework, assessing the size and complexity of the cross-border business, also in measuring the riskiness of the investment portfolio of an undertaking, but then also taking into account basic Solvency II ratios like the SCR compliance. And maybe one aspect, and this is now in the light blue part on the bottom of the slide, is that undertakings that pursue life and non-life business, there you need to decide based on the materiality of such activities which exact criteria need to be complied with. And for this assessment, we use, or the directive references the life technical provisions over 20% of the total technical provisions to consider life activities material. And for non-life, it refers to the non-life gross written premiums above 40% of the total gross written premiums. And I recommend that you keep this in mind, because when we talk about the technical EIOPA technical specifications for the SNC criteria, we will come back to this materiality thresholds. To not forget groups, Article 213A applies the SNCU framework mutatis mutandis to groups, and basically all the criteria stay the same, of course using group-specific terminology, but also like the size thresholds, they have not been changed for groups, so the criteria are really the same. So I think by now you should have answers to the question, what are SNCUs, how small and non-complex is defined. But before moving to the proportionality measures, I would stay for another minute on with the type of undertakings, because the framework introduces a dedicated regime also for captive insurance and captive reinsurance undertakings. And as we have the legal definition of captives already in the directive, so these are undertakings owned by a financial company that only insures the risks of this parent or the group. So it's self-insurance. These captives, one could say not the winner takes it all, but the captive takes it all, because they have 2 options to become small and non-complex. And the first option is basically very similar to the one that I presented on the previous slide. So it's compliance with the quantitative criteria. But already here, captives have a reduced set of criteria that they need to be complied with. So due to the nature of self-insurance, captives do not comply with the cross-border criterion and also not with the accepted reinsurance criterion. And to illustrate what this could mean in practice, so on the previous slide, I referred to that pure reinsurers, so the reinsurance undertakings can never become small and non-complex. So for captive reinsurance undertakings, they can become small and non-complex. But even if captives do not comply with this reduced set of quantitative criteria, so their possible road to become SNCU is not over, because they have this second option, which is a more qualitative assessment. So if captives only insure the legal entities of the same group, or the natural persons that are covered by such policies remain below 5% of the technical provisions, as well as the captive does not offer compulsory third-party liability insurance, the captive is also a small and non-complex undertaking, and therefore has access to all proportionality measures that are granted to, or that SNCUs can automatically access. And so on these proportionality measures, we have overall 10 of them defined in the Solvency II directive, and they range across all the 3 pillars of the Solvency II framework. And also, in the interest of time, I will always mention only one for each pillar. And it's easy for pillar 1 on capital requirements, because here we have only the prudent deterministic valuation of immaterial options and guarantees. So the second last bullet on the right column. Then on pillar 2 and governance related requirements, the proportionality measures are mainly concerning the author. So on the left column on the bottom, you see that the author is required only every 2 years instead of annually. And also there are other measures or waivers from the new macroprudential measures that have been added. So like liquidity risk planning, and also related to the climate change scenario analysis is waived for SNCUs. And last but not least, on pillar 3, regarding reporting and disclosure, here also proportionality measures are existing. For example, that the RSR is only due every 3 years, and if permitted by the supervisory authority, only every 5 years. And also on the disclosure side, some proportionality measures exist. Also to mention that there is an exemption from the audit of the balance sheet disclosed and the SFCR. So it's mentioned here, but it's also with a disclaimer that in the directive, this is a member state option. So it really depends on the transposition of the directive. So, and therefore, if on the individual member states, whether an SNCU has access to this proportionality measures. And with this, I would move now to the second part of my presentation, which is actually a step towards the operationalization of the framework. As you might know, EIOPA has published in April a document on the technical specification of the SNC criteria. And with this document, we really wanted to ensure an accurate calculation across all the markets, to have reliable, credible outcomes of the SNCU framework, and also to avoid like regulatory arbitrage. And as we were relying on the existing reporting framework, we think that this tool does not place the undue regulatory burden on supervisors, but also on the industry. And to underline also our commitment and the credibility of the document, it was nevertheless approved by the EIOPA BOS. But in the next slide, you see basically one major step that we needed to decide on how to ensure that in all circumstances we ensure that undertakings are assessed against the correct set of criteria. So here we wanted, as I said on the beginning, we wanted to avoid like regulatory arbitrage. We wanted to ensure that the results coming out from the SNCU assessment are really credible and reliable. And we did so by, and if you want to remember, or if you can remember only one sentence or have a high-level summary of this slide, we did so by classifying the activity to clarify the calculation of the criteria. And we did so by classifying the activity of an undertaking by using the authorization that is given in the Solvency II framework, where an undertaking is authorized to pursue business in certain insurance classes, whether life or non-life. And with this approach, to make it more concrete, so an undertaking that is authorized as non-life insurance undertaking, it should be assessed against the list that is applicable to non-life undertakings. So also taking into account the combined ratio and also the criteria relating to marine, aviation, transport, credit and surety ship lines of business. However, when developing or working on this document, we also noticed that in very few circumstances, focusing only on authorization, this would ignore the actual risks of the undertaking, and therefore we added or we proposed a second step, and this is only where it's appropriate and eligible, so that also the materiality of the insurance activities should be assessed. So, and also to come back to the slide that I presented to you in the first section, we are using here the materiality thresholds that were indicated in the light blue box on this slide. So for life, referring to life technical provisions, and for non-life to the gross written premiums. So, but with this layered approach, we ensure that in all circumstances that undertakings are really, or that always the right catalog of criteria is used for the assessment of undertakings to become small and non-complex. And then moving to the content and the technical specifications of the criteria, you see again on the left side, on the left column, all the 9 quantitative criterion, and then when moving to the right, you see many more formulas and even more templates in the right column. And I want to highlight 3 things with regard to this slide. So, and the first thing is really that the SNCU framework is a new framework. However, with our document, we demonstrated that already we have the tools to apply it with the existing reporting framework. So you see, for every criterion, we have QRTs that already exist. So there is no need to develop new or additional reporting. However, as we've heard from Giovanni, there might be also in the future a review of the reporting requirements. So we consider this technical document as a living document, which might in the future take also into account experiences from supervisors which they have gained after the application of the new framework, or if the reporting requirements have been revised, so the calculations will be updated. And to be on this aspect more specific, so as EIOPA has submitted to the Commission in March its draft proposal for the revision of the implementing technical standards on reporting. Based on this draft, we expect only minor or no changes at all regarding the technical specifications going forward. And before closing my presentation, I would again like to take a step back from the operationalization more to the legal framework, because now we've talked about what are SNCUs, what are the benefits of them, and what is small and non-complex, but we have not covered the actual process, so the road to become small and non-complex. And luckily, we have Article 29b of the directive, which gives already many answers to questions that arise in this aspect. And Article 29b already clarifies how the application of the undertaking has to look like. So it needs to submit evidence of compliance with the SNCU criteria to the supervisor, but also a declaration that no strategic changes are planned in the next 3 years. It defines a clear role for supervisory authorities, so they have a really defined timeline within which they need to decide on the applications. And if there is no reaction from the supervisor, the undertaking will be automatically classified as small and non-complex. And the supervisor has also only limited grounds to reject, which are also clearly defined in this Article 29b. And maybe as last item, it also clarifies the duration of the classification. So for as long as you comply with the conditions, you stay SNCU forever. However, if there is persistent non-compliance over 2 years, so the status of SNCU might cease after 2 years with the third financial year. And so before providing you with more details, I think we are extremely pleased to have also Luciano Mikalev here with us from the Malta Financial Services Authority, who can actually share his practical experience and also the efforts of his authority, how to bring these legal provisions really into the real world and make them work. So I give the floor over to you, Luciano, and welcome, and the floor is yours.
Thank you, Johannes. Good morning, everyone. I hope you can hear me very well. First of all, I would like to thank EIOPA for giving the MFSA the opportunity to deliver this presentation. I will be sharing the presentation as well. I hope you can see that. When we talk about Solvency II, we often think of it as a regulatory framework being technical, complex, and highly structured. But sometimes we forget that behind every framework lies a journey of interpretation, adaptation, and ultimately readiness. And today, I will take you through that journey, specifically how the MFSA moved from review to readiness in implementing the Solvency II 2020 updates. This was not simply an exercise in compliance, as you will see through this presentation. It was about proactively engaging with the market, revisiting and strengthening supervisory practices, and ensuring that both the authority and the market are well prepared for the upcoming changes. Throughout this presentation, I will highlight the key milestones and the practical steps that transformed regulatory review into operational readiness, with particular focus on SNCUs and SNCGs. But I think before we go further into this presentation, I think it's important to start off with an overview of the insurance sector in Malta to help the audience put things in perspective, particularly for those who may not be so much familiar with the Maltese insurance market. So Malta's insurance sector has expanded significantly over the past 20 years, growing from 5 to 70 undertakings, employing over 1,400 people, and generating around 10 billion in gross premiums based on latest figures. As an international financial services center across all financial sectors, Malta hosts insurers that predominantly operate on a cross-border business. The MFSA, in this regard, has established robust processes for cross-border supervision, supported by strong ongoing collaboration with EU and non-EU regulators. Approximately 30% of all undertakings are expected to fall within the SNCU category, and this is based on data available at the MFSA using the technical specifications also being referred to by colleague Johannes. And we would have around a significant number of undertakings, approximately another 40 to 50%, who are expected to apply to benefit from proportionality measures. This percentage is based on feedback we have been provided by the market by means of a questionnaire, which undertakings were asked to complete as part of the consultation. but I will come later on this, providing more detail in this presentation. So over here, as you can see, this is MFSA's roadmap as regards to the Solvency II review. The starting point was the establishment of an internal working group made of highly technical individuals and supervisors within the team responsible to establish this roadmap and milestones as well to prepare for the implementation of the changes brought about by the Solvency II 2020 review. Preparation started as from 2025, and the first half of 2026 was primarily focusing on strong engagement with our market, using various tools to allow enough time in the second half then of 2026 to finalize our internal processes, revisit supervisory methodologies and tools as required, issue the feedback statement following the public consultation, and possibly any additional circulars that would be required, and be ready to receive the first applications as well as from January 2027. Through this slide, I tried to condense as much as possible the preparatory and implementation work undertaken by the MFSA with regards to Solvency II review. One of the first steps was the authorization and supervisory teams carrying out a detailed review of the directive to identify key material issues for the Maltese market, supported by internal discussions and assessment of impacts on the MFSA supervisory processes, methodology, and supervisory tools. The MFSA also actively participated in EU Commission transposition workshops, raising queries where required, obtaining clarifications as well. We did our own research and discussions with other regulators as well to ensure supervisory convergence. Training was a very important element throughout this journey to get up to speed with the changes coming up. In this regard, MFSA staff participated in EIOPA training that was available, but also provided internal training to all concerned staff in order to enhance the level of understanding of the changes brought about and the implications that this would have on the supervisory and authorizations work, including adapting any new or revised current processes, methodologies, and tools as we go along. Another important aspect in this preparatory phase was that MFSA staff also actively participated in EIOPA expert working groups, contributing to drafting ITSs and RTSs like other colleagues, joining other colleagues within the EU member states. There was also the need to develop certain new tools to enable efficient and timely implementation of the review as well. Moving on to my next slide, and the event that actually was the highlight of the beginning of 2026 was actually the MFSA Insurance Conference 2026, which served as the launching pad of MFSA's consultation with the insurance market and stakeholders. The conference featured keynote speeches and panel discussions led by senior MFSA officials, international experts, and industry representatives. Amongst the guest speakers, we also had Mr. Giovanni Rago, Head of Supervisory Convergence at EIOPA, and Ms. Elena Barra Caracciolo, who's a senior officer at EVAS, who contributed insights on cross-border supervision, simplification and burden reduction, proportionality, and the passporting implications for insurers operating across Europe. Obviously, the conference as well captured MFSA's implementation journey, just to give a good understanding to our market how we intend to approach the review and the upcoming changes, but also introduce the concept of SNCUs, how to be eligible, how to become one, etc. The conference was then followed by a public consultation, which is actually split into two phases. First phase is where the MFSA issued the first consultation document, which was several pages long, around 20 pages, giving quite some detail there. And this consultation document primarily addressed concepts related to implementation issues, the expectations of the MFSA, and information on the proposed legislative options to be adopted. In this consultation as well, the MFSA sought feedback on the key principles stemming from the amending Solvency II directive, including the new proportionality framework and the proposed application process. The consultation also set out supervisory expectations of the MFSA with a view to facilitate the effective and timely transposition and implementation of the revised framework, trying to, as much as possible, reduce the risk of any backlog of applications still under evaluation. An important element within this consultation document was the questionnaire that I already alluded to before, where undertakings were urged to complete. And the idea behind this questionnaire was for the MFSA to get a better understanding of which undertakings intend to notify the MFSA to be categorized as SNCUs, also to inform the MFSA of those undertakings intended to apply to be eligible for proportionality measures, or those who would not be applying for any of the above. When undertaking intends to notify the MFSA to be categorized as SNCU or applying for proportionality measures, they were also asked to give an indication when they intend to submit their application. Obviously, this would help us from an operational point of view to make sure that all applications are reviewed in a timely manner, because obviously the period for our no objection or approval is relatively short. Then when it comes to those undertakings who do not qualify as SNCUs but wish to apply for proportionality measures, we're also asked to give an indication which proportional measures they will be applying for. And one final question here in this questionnaire was urging the market to come up with questions, concerns, issues, or clarifications the undertaking would like to tackle during the workshops that were going to be carried out after this consultation, after this first phase. As I mentioned, the public consultation consists of two phases. The second phase is expected to be, the second consultation document will be issued later during the year, and it's specifically dedicated to the actual transposition of the amending directive. This will entail significant changes, obviously, to our local legislation, the Insurance Business Act, but also a number of regulations will also need to be amended, whilst possibly new regulations would need to be published to transpose, particularly Articles 29A to 29D of the directive. The consultation also included an additional annex, which contained open questions. And whilst the stakeholders were not expected to provide replies to these questions, the questions were more intended to stimulate and provoke internal discussions within the company, or primarily at the board level, at senior management, and also at key function holders. And in fact, over here, I am replicating some of the questions which were actually included in this annex, just to give you a bit of a taster what these were all about. And if I had to read a bit sort of the first question, we are saying, is the undertaking anticipating any challenges to conduct the quantitative and qualitative assessments to classify the authorized insurance undertaking or authorized reinsurance undertaking as SNCU as specified in Article 29A of the amending directive, what operational or data challenges do you anticipate in meeting the SNCU criteria? How is the undertaking preparing towards any changes in relation to the revised governance requirements? What changes will be required in your governance structure to meet the new independence and diversity expectations? So as you can see, these questions were there to provoke thinking. Another important milestone as part of MFSA's journey were the actual workshops held with the insurance industry, including other stakeholders such as local law firms, auditors, and advisors. These workshops served as an interactive platform to review MFSA consultation document, which was issued in April. And to maximize the relevance, the MFSA segmented the industry into 3 specific focus groups. One of the groups consisted of undertakings carrying on general and long-term business and predominantly writing risks mainly in Malta. Another group was tailored for undertakings predominantly writing risks via cross-border, and definitely this was the largest group. In fact, we had to split them into 2 groups. And another group covering the low-risk structures, so exclusively focusing more on captive insurers and insurance managers. My colleagues already touched upon this, so I will just skim through. How to become an SNCU? So the most important thing is that undertakings carry out a self-assessment. It is the start of the process to ensure whether they are, to check whether they are eligible or not. They are requested to analyze both quantitative and qualitative data, which has been already also touched upon by Johannes, but most importantly as well, to commit that there won't be any strategic or significant changes in the risk profile for the next 2 to 3 years. Once an undertaking is eligible and it receives no objection from the MFSA, then that undertaking can benefit basically from all proportionality measures. After completing the self-assessment and concluding that an undertaking is eligible for SNCO status, the undertaking must notify the MFSA by submitting the official notification form. This is a new form that the MFSA specifically developed to assist license holders in determining whether they are fit within the SNCO criteria. I have prepared some slides as well to help you visualize how this form looks like. Such form also ensures an efficient and effective way as to how undertakings are to notify the MFSA, and it allows for better convergence and transparency of the process adopted by the MFSA. As SNCU, it may apply for all proportionality measures. The MFSA has 2 months to object and 4 months for applications submitted between January and July of 2027 in line with the Solvency II Review Directive. For the MFSA to be able to process the notification, submissions must be complete and include all supporting documentations. The MFSA, as we have seen before as well, may reject the status if eligibility criteria are not met, or if the risk profile is considered to be too complex. It is important to note as well that undertakings need to satisfy the SNCO criteria for the past 2 consecutive financial years in accordance with the technical specifications for the calculation of criteria for SNCOs and SNCGs in order to be able to be eligible for SNC status. In the next 2 slides, actually, I will provide a high-level overview of what this form looks like. This form structure is basically Articles 29A, B, and C of the Solvency II Review Directive, and it is split into 6 sections. Section 1 is the area which requests for the identification of the undertaking. Then Section 2, in this section, license holder needs to fill only the applicable category, whether the undertaking in question is life material, non-life material, or material for both life and non-life. If none are satisfied according to the criteria, then the undertaking needs to refer to previous classes for run-off entities or current authorization classes. When it comes to Section 3, this details the criteria which immediately excludes a license holder from SNCO status, whilst Section 4 asks for the proportionality measures that the license holder intends to apply. So over here, undertaking would need to give a brief explanation as to how the selected measures will apply to the business. Then it also contains 2 other sections. Section 5 identifies the documents required which support the information included in the form, while Section 6 contains a declaration and then obviously includes a space for signature. And the declaration would need to state there is no intention of changing the business model in such a way that it will no longer qualify as SNC in the next 2 to 3 years. In this slide, I'm providing an overview of some factors that will be taken into consideration by the MFSA in its assessment, which will affect SNCU eligibility. So an undertaking is likely to qualify as an SNCU if it is doing has very limited cross-border exposure, is distributing simple product lines, has strong governance and compliance culture, and there is no material conduct or operational risks. Undertakings that are unlikely to qualify as SNCUs are those undertakings that are doing significant FOS business across multiple countries, have a high reliance on intermediaries. As well, they are heavily reliant on providing delegation of underwriting and claims authority, distributing complex products in host markets, and also possibly if there's rapid growth in foreign jurisdictions. Moving a bit to SNCGs, given that there are different key thresholds upon consolidation at group level, the MFSA will be issuing a specific application for groups where Malta is the group supervisor. So this would look similarly to what I have shown you before, but it would be specifically applicable to groups. Those groups which fail to qualify as SNCGs would still be eligible to apply for proportionality measures at group level as well as at solo level. So a group can qualify as SNCG even if some entities are not SNCUs. A group can fail SNCG even if all subsidiaries are small individually. This is because ultimately the overall group profile drives the assessment. What happens then after becoming an SNCU? So an undertaking remains classified as SNCU unless the non-compliance with the criteria persists for 2 consecutive years, or if the undertaking falls under the category of undertakings that cannot be an SNCU. And specifically over here, I'm referring to the exclusion under Article 29A3. If an SNCU no longer meets the criteria, then it is obliged to notify the MFSA without delay. And in line with Article 29C of the amending directive, the MFSA may request SNCU to refrain using certain proportionality measures in case of serious concerns in relation to their risk profile. And these cases would be non-compliance or the risk of non-compliance with the SCR, ineffective governance system, and material changes in the risk profile that could lead to non-compliance with SNCU criteria. How our undertakings will be submitting the notification. This would be done through a digital portal, which has been specifically developed for license holders. It's not simply used for these forms, but it is a digital portal where our submissions are requested to be submitted by license holders. Early submissions would be welcomed as from beginning of January 2027. This would help as well the MFSA team to start looking at these applications and familiarizing themselves with the content of what we are receiving. But obviously we cannot give our no objection to such notifications before the 30th of January when the directive comes into force. The evidence of compliance with the criteria may be based on the latest 2 sets of audited financial statements, and then finally a decision will be communicated to the license holder by the MFSA. My final slide on captives. So, as you are aware, captive undertakings already benefit from a range of proportionality measures, but with the upcoming changes, more proportionality measures can be actually applied. With the captives are benefiting from simplified criteria, but still need to apply the MFSA to be classified as SNCUs. Captives not qualifying as SNCUs may still apply to make use of proportionality measures, and captives that do not automatically qualify as SNCUs are still subject to a notification. But obviously, once an undertaking meets the definition of a captive, the process is expected to be much simpler. Although it may still exceptionally not meet the SNCU thresholds, in which case then a captive would need to apply for proportionality measures. With this slide, I come to the end of my presentation, and I pass on to Jacopo. Thank you very much.
Thanks a lot, Luciano, for a very concrete example on how NCAs are already implementing the revised proportionality framework. And it was really an interesting insight from the national perspective. Now, we move to the last item of this session on small and non-complex undertakings and groups, and then we will also allow a moment for the Q&A session, the Q&A discussion on this specific item. Regarding the last item, we scheduled also an overview of a work that was conducted at EIOPA level on on the results of an impact assessment that EIOPA conducted on the new proportionality framework. I'm pleased to welcome here Sebastiano Russo, which is expert on data analysis and processes at EIOPA. We will work out some key assumptions when reading the results, and then Sebastiano will walk us through the key results of our impact assessment. We wanted first to clarify that the results are based on data that refers to the 2023 and 2024 financial years. As we learned from Johannes, undertakings need to comply with the small and non-complex criteria for two consecutive financial years. So we took into account 2023 and 2024 data. In our methodology, we also strive to distinguish between insurance and insurance undertakings and captives. So we will make a clear distinction between undertakings that are not captives from those that are considered that only perform captive business. And also specifically regarding captive, we wanted to highlight that we don't have reporting data on the number of captives that operate in Europe, and therefore we had to rely on the EIOPA expert judgment. This is just to say that the actual number of captives might not be reflect exactly the number of captives that are registered at national level. Then two very important disclaimers. The results of the impact assessment were produced solely by EIOPA for analytical purposes, and they do not have to be considered as a prediction of the outcomes of the implementation of the framework. This means that the final number of small and complex undertakings after the entry into application of the framework might differ from the data that the results that we are presenting today. And specifically on the analysis at country level, because we will show data at European Economic Area level and also at country level, but the results at country level do not reflect the views of the national competent authorities. As again, we learned from the overview of the regulatory framework, also the part of the framework applying to small and complex undertakings implies a certain degree of supervisory judgment that cannot be inferred from the quantitative analysis of the QRTs in line with the technical specification that we published. So having clarified this, I will give the floor to Sebastiano for the overview of the results.
Thank you very much for this opportunity. It's a pleasure for me to can contribute to this discussion. So please keep in mind what Jacopo specified now in terms of key assumption. Please remember what Joanna said also before regarding quantitative and qualitative criteria. So I would like to start sharing with you some key results on this EIOPA internal impact assessment. And I would like to start to say that in terms of sites, we are expecting around 660 insurance and insurance undertaking, including captive, that could be eligible to be classified as small and complex. To give you an idea, in terms of sites, we are talking about around 28% of the overall number of undertakings in the European Economic Area that could be in the scope of this proportionality framework. Going more in deep and analyzing these 660 undertakings, as you can see from the table, we have 369 insurance undertaking that could be insurance and insurance undertaking that could be eligible as small and complex. And then we have 291 potential captive that could be eligible as a small and complex undertaking. If you focus for a moment to the graph below on captive, as you can see, for these 292, we identify, let's say, two regimes. There are 122 that could be eligible, captive that could be eligible as a small and complex because they are compliant with the quantitative simplified criteria that Johannes mentioned before. And then there are the remaining 169 captive that are eligible due to the specific regime that Johannes mentioned before. If you look now for a moment at the table and you focus initially to the last column, the one referring to the number of the EIA undertakings, as you can see, we have around 1,200 non-life undertakings. So let's say almost 3 times the number of the life undertakings. And probably this can help us to understand why we have, in terms of numbers, 343 undertakings coming from non-life business, and let's say only 80 life, 80 small and complex undertakings coming from life business. So in absolute term, let's say 343 seems to be much higher than 80. But if you look now at the graph below with the incidence by type of business, and you focus on the bar for the non-life business and the bar on life business, as you can see, in relative terms, this number seems to be much lower because both bars are aligned around the range of 20%. And if you look also the last bar, the one relative to reinsurance, it seems that we have there a much higher incidence that is around 60%. But this is not surprising us because if you go back for a moment to the table and you focus on the column for small and non-complex, as you can see, you have 181 small and non-complex that are coming mainly from captive and they're coming from for insurance business. So considering also the role of captive business and the important role of captive business to reinsure the group where they belong to, we can expect this much higher incidence. Going to the next slide, here Iopa would like to share with you a visual map with the geographical incidence at country level of the small and non-complex, let's say, impact and benefit. And again, I would like to repeat what Jacopo said. This visual map, this geographical, let's say, incidence, is not intended to take into account all the potential discretionary powers that are guaranteed by the framework to the NCAs during their assessment phase at local level or during the notification process. Here, our intention is to share with you this graph and to share with you our interpretation of this number. As you can see, there is the geographical distribution of all the EEA area, and there are, let's say, different degree of group. In our view, one potential driver to justify light blue area or dark blue area could be the level of insurance market concentration. If, for instance, you look countries that are in the light blue area, as you can see, you have a more limited number of undertakings that are operating in this country. And among these undertakings, there is a higher incidence of insurance big player based on non-life gross written premium or based on life TP. In our view, this is the case where you have a higher concentration of the insurance market, and under this condition, in the light blue area, you can expect a more limited impact of the small non-complex, let's say, benefit. But if you look a country where you have a dark blue area, as you can see, the number of the undertaking is much higher, and there will be probably more small insurance player based on TP or gross written premium. And here, the benefit of the smaller non-complex premium, in our view, is driven by a lower market concentration of the insurance business. So I can say this, I will give the floor again to Jacopo, and thank you.
Thanks a lot, Sebastiano. And it was, I think, a fair conclusion of this session to also have an idea of the impacts of the new framework. Now, before moving to the last session on undertakings that do not classify as small and non-complex, we wanted to allow a moment to exchange on the questions that you submitted. And as you might have already seen, we are also trying to respond in writing, but we thought it would be also interesting to hear from the speakers directly regarding some question. Now, still quickly, because we are 2 minutes behind the schedule, I believe I have one question for Johannes regarding the captive business. If you would be able to provide the definition or example of compulsory third-party liability insurance.
Thank you, Jacopo. And yeah, this one is indeed difficult to answer. And as you probably have also seen in the impact assessments are really regarding captive. it depends on the individual or like expert judgment. However, and as mandatory third-party liability insurance can also be member state specific. So this is very hard to answer, but I can give like an example for a European-wide mandatory third-party liability insurance. And this is like for airplanes. If an airplane wants to land at an airport in Europe, it is required to have this kind of mandatory third-party liability insurance. So this is one concrete example for this case.
Thanks a lot. And I think also another question that we can address to you regarding the SFCR. The participants mentioned that there will be a significant ease in reporting. However, will there be a template for SFCR and RSR developed for the benefit of the small and complex undertakings?
I think regarding this question, so I would also refer to what Giovanni said with regard to the ITS on reporting. So there we have included proposals that ease the requirements for small and non-complex undertakings. So for example, they have only semi-annual reporting, so no reporting Q3 and Q1. However, in general, the ITS on reporting, so also in this case, pending on the adoption by the Commission, there is, they apply to all insurance undertaking, and with this, if this specific proposals from IOPA are taken on board, then there are some easing for SNCU, but overall, the ITS on reporting and also on disclosure will remain as they are, and also as was underlined for the technical specification. So we really used the existing reporting framework, so there was no need to adapt, and it delivered so the results that we hoped for.
Thanks a lot. I think we still have some time for one last question still to you. Regarding runoffs, I think I can summarize a bit the question. Runoffs no longer underwrite new business and are focusing on managing existing insurance liabilities. The question refers to the EIOPA technical specifications that especially the combined ratio that includes an indicator based on net earned premiums. However, for runoff undertaking, such premiums may be negligible or equal to zero. So they are asking to explain how these indicators can be applied to runoff, and if you can provide your view on this regard.
Okay. Now, perhaps also to clarify that also one main intention of the document on the technical specifications was really to engage or like to foster early dialogue between supervised entities and the supervisory authority. So, and as we were aware that the technical specification cannot capture all possible scenarios, so for the moment we kept them to the basic ones, as we also don't have experience with the SNCU framework. So we would encourage to directly get in contact with your relevant supervisory authority. And as I mentioned during my presentation, we consider the document as a living document. So based on first practical experience with the framework, and after receiving the application, at some moment in time, we will also discuss whether these additional scenarios need to be taken into account in future versions of the document.
Okay. Thanks a lot, Johannes. I think in the interest of time, we can now move to the last session, and if time allows, we can also go back to questions related to previous sessions. We are now starting the session regarding the part of the framework that applies to undertakings that do not formally meet the small and non-complex criteria, but considering their individual risk profiles might still benefit from individual proportionality measures. To introduce this topic, I will briefly change hat and I will walk you quickly through the regulatory framework. And then we will have, as anticipated, a practical experience on how this part of the framework is being implemented at national level. The relevant provisions that we need to refer to is Article 29D, which allows undertakings that do not classify as small and non-complex to apply a more limited list of proportionality measures on the basis of the prior approval of the supervisory authority. There are therefore key elements to be taken into account. First, that the list of proportionality measures for undertakings that are not small and non-complex do not exactly match with the proportionality measures allowed for the small and non-complex ones. Second, undertakings need to submit a written request to the supervisory authority. This shall include the list of proportionality measures that the undertakings intend to apply and the relevant justification based on the nature, scale, and complexity of the undertaking's risks, all relevant information on the risk profile, and a declaration that the undertaking does not foresee a strategic change in the next 3 years. Following the written request, the supervisory authority will need to adopt a supervisory decision, either to approve, reject, or conditionally approve the measures. In this specific part of the framework, the reversal of burden of proof is not applicable. This means that supervisors will need to assess on the basis of the elements provided by the undertaking and provide an answer on whether the proportionality measures can be applied. Last element, the amendment or the withdrawal of the approved proportionality measures can occur at any point in time, and it will require an additional decision from the supervisory authority. Here we provided with an overview of the regulatory journey that led to the development of this specific section of the framework. Solvency II generally allows undertakings that do not classify as small and non-complex to apply proportionality measures, all subject to approval of the supervisors. However, it mandated the European Commission to develop delegated acts containing conditions on granting and withdrawing those proportionality measures. EIOPA was therefore requested by the Commission to deliver a technical advice on this subject matter that was issued on 30 January 2025, and the advice was broadly received in the revised delegated regulation, which now specifies the concrete conditions. The advice is available on the EIOPA website, and it can be used as a valuable tool with background considerations, condition by condition. In line with what EIOPA proposed, the conditions to apply proportionality measures for non-small and non-complex undertaking are split into two main categories. There are general conditions that aim to assess the risk profile of the undertaking vis-à-vis any type of measures that the undertaking intend to apply. In this case, we propose to have 5 general conditions. First, the first condition pertains to the stability of the undertaking. So throughout the supervisory review process, the undertaking will need to show that it's able to withstand current and future risks, does not require more frequent supervisory assessment, and is not subject to ongoing supervisory measures. The undertaking will also need to have a straightforward and stable business model, having regard to the stability products mix, complexity of investment, change of policies. We also introduce a size criterion. It is important to have also clear standards that excludes the largest insurers from applying proportionality measures, bearing in mind that also in case of simple activities, those insurers will be able to engage with the supervisor and demonstrate that individual measures can be applied. Also, one condition on capital adequacy, meaning that the supervisory capital requirement should be met with an appropriate margin that reflects a sound financial position and the capital management plan of the undertaking. And the last condition relates to the governance, meaning that no significant governance issues shall be identified in the past 3 years. The second set of conditions is related to the specific proportionality measure that the undertakings need to wants to apply. This means that the undertaking will need to comply with the general condition that we saw in the previous slide and with the additional conditions that the framework prescribes. One last slide at group level. Also for the undertakings that do not classify as small and non-complex, the framework applies the mutatis mutandis approach. This means that the conditions can be extended also at group level in case a group intends to apply specific proportionality measures. But the delegated regulation also provides additional guidance on how to specifically assess the business model at group level. The supervisor shall take into account the group structure, the number of jurisdictions in which the group operates, the proportion of the group's activities performed outside the home member state of the parent undertaking, and also the significance in terms of numbers and revenues of undertakings that are not insurance or insurance undertaking and belongs to the group. And finally, one last element is the materiality of the intragroup transactions. As we saw, the delegated regulation provided a very comprehensive overview of the conditions that still needs to be implemented at national level. For this reason, we have now a last item on our agenda that concludes the sessions that we wanted to focus on today. And we are pleased to welcome now David Rebellin, that is Deputy Director in the International Affairs Directorate in the French National Competent Authority, the Autorité de Contrôle Prudentiel et de Résolution. And David will share the ACPR approach in the implementation of the proportionality framework for undertakings that do not classify as small and non-complex. David, the floor is yours.
Thanks a lot, Jacopo. I am sharing my slides. Things work. Voilà. So thanks a lot for this presentation. I will be going through how we have implemented and how we are planning to implement the framework for non-SNCUs and non-SNCGs in ACPR for the French market. I am conscious that I am the last thing standing between you and lunch after this very full morning full of information, so I'll try to be quick. Just before starting on the practical details, I just wanted to highlight a few elements which will also echo what has been referenced by the previous speakers. As you will see, I will present figures for the French market, but we have a large number of undertakings on the French market. It was presented in the impact assessment. More than 400 are submitted to Solvency II. And among those, we have a large number of undertakings which will be potentially qualifying as non-SNCs. And which means that this is a very important topic for us. And this topic has been reaffirmed by the ACPR senior management on various occasions. And we have a strong commitment to make sure that the proportionality regime in the Solvency II review is successful. So we are conscious that now it's now that the legislation has been adopted and is going to enter into force. Now it's our role as supervisors to make sure that this is delivered concretely to undertakings. So that's my first point. My second point is also from the ACPR perspective. We lay a very important emphasis on simplification. We usually say simplification without deregulation. I think Mark has clearly highlighted that simplification is also important for resilience, that they go hand in hand. And this is especially important for us. So simplification is also a way for us to continue implementing a risk-based approach in our supervision, and Damian also mentioned it. And why is it important? It's important because it enables us as supervisors to better focus our supervisory resources on what really matters and on priorities, and our resources are limited. So we want to focus it on the most important points. And also, and Mark mentioned it, also we don't want to uselessly mobilize the attention of management in undertakings on things which are not helpful. So we want to make sure that they focus on what really matters. And what really matters first, of course, is their business and their risk. So that's also very important for us. Of course, this is going to require discipline from us as supervisors to make sure that this is implemented properly. I mean, this discipline also echoes, and that's my third point, sorry, something that we've been very important for us at ACPR for a long time, because we've already been making use of what the Solvency II regime allowed before the review. Typically, we already enabled quite a number of undertakings on our market not to submit most of the quarterly reporting. We already enabled a combination of key functions for quite a number of undertakings, and that was provided with national guidelines. So it's very important for us to make sure that this remains the case, and that's why we are committed to the Solvency II review proportionality measures, to make sure that we have something which is outcome focused rather than just focusing on processes. And to make sure this is outcome focused, we've tried to put that in practice already, and start working very soon to make sure that undertakings had sufficient time to prepare to the new framework, and also to make sure that internally we had sufficient time, because again, we are going to have hundreds of undertakings potentially submitting applications, so we needed to be ready in advance. So we
Sorry,
started
to interrupt.
Yeah.
Just a question. We see the first slide. That I don't know if you are moving.
Yeah, no, I haven't moved yet. This was just the introduction. Sorry.
Okay, sorry for that. I just wanted to check.
Yeah. But I'll be quick. So make sure that undertakings have sufficient time in advance to prepare, and also make sure that the application is consistent between undertakings. That's also very important for us. Lots of undertakings are concerned, and we want to make sure that there's level playing field in application across our market. And of course, that's also important at the European level, but at least within the market. So to move to the first slide, indeed, why is it important? Because in terms of number of undertaking concern, and this is already what was mentioned by partly by the presentation by Sebastiano and Jacopo, we have around 80 SNCUs on the French market. So the presentation mentioned 89. Don't worry, it's consistent because we have 9 companies which actually are potentially going to move from Solvency II to Solvency I. So we are perfectly consistent with the EIOPA numbers. And what's more important is that in terms of non-SNCs, we have 300 potentially undertakings eligible for proportionality measures and 40 groups. So that's very important for us to make sure that this works because there's a large number of undertaking concerns. And it's mostly on the non-SNC, so let's say the medium-sized undertakings. We already did a survey back in October on market expectations, and we already had 2/3 of non-SNC's respondents, which were planning to ask for use of at least one proportionality measure. So how did we approach this? We approached this by issuing several instructions which clarify the procedural aspects and guidance related to proportionality. And the idea behind these instructions and guidance is to provide entities with transparency on our expectations, so make sure that they are aware of what we expect soon enough, while leaving sufficient room for expert judgment. I'll come back to that. We have criteria which are both deterministic, so which say clearly this will not fly for application of proportionality measures for non-SNCs, and some which are more expert-based, where we have several indices which will take into account to come to our judgment. And then, so this is, let's say, the red part, the orange part somewhere in between, and we also have, of course, let's say, green part, where it will be clear for undertakings that if none of the criteria is fulfilled, they will be able to apply the proportionality measures without further questioning. This, in terms of timelines, these criteria have been consulted with the industry. So we've already been, well, first we had some preparatory work internally. We took some time. And then we were in a position to be in place by April to consult with our industry. So we had 3 months of exchange with our industry, which will mean that we'll be able to publish in July, so in a couple of weeks, our instructions and our guidance to the market, pending approval by the board, which is supposed to take place on July 10. Now, what have we used in terms of deterministic expert judgment criteria? So for SNCUs, there is a question of the system of governance, which is not effective. I will not come back to that. But let's say we have had a similar approach for non-SNCs around also the criteria concerning governance. So as I was saying, for non-SNCs, we are going to apply 2 types of criteria, some what we call deterministic criteria, which clearly lead to the automatic rejection of all or of certain proportionality measures, and some expert judgment criteria, which more give us base for review on a case-by-case basis. What has to be clear is our objective is not to reject many criteria, many applications. On the contrary, we have made some impact assessment internally on how the various criteria would play out, and we hope to be in a situation where actually these criteria do not lead to a high number of proportionality applications being rejected. So our objective is still that the vast majority of application can lead to the proportionality measures being implemented, as this is our overarching objective. One case where we've decided to keep things simple because, as was mentioned, the criteria are already complex enough. In light of the SRP, we can consider safely that entities which are above the very high threshold of 20 billion euros TP for life and 20 billion euros premiums for non-life, they do not have a sufficiently low risk profile to be eligible for proportionality measures. So basically, above these quantitative threshold, we consider that companies are not eligible for proportionality measures. So we focus the 300 are the ones which are below this quantitative threshold and which are eligible. Now, this is again the same idea, but this time focusing, so this was explained by Jacopo. For the non-SNCs, you have a different type of, let's say, overall criteria which can be taken into account in assessing whether we accept proportionality measures or not. The first package of measures is concerning the supervisory review process. And on this, we have made a decision tree based on the SRP rating. So this is an overall criteria that we're giving, because the SRP rating is not communicated to undertakings as such. But clearly, our idea is that, especially concerning solvency and profitability assessment in the SRP, if you rank high in our notation, in our SRP internal notation, there will be automatic rejection of all proportionality measures. But again, that concerns a very few number of undertakings on the market. And then if you're medium high on these SRP ratings, then this is part of the various elements that we will take into account in the expert judgment. And again, if you're medium low or low, then clearly this is not something that can then trigger potential rejection of the proportionality measures. So again, here, medium, high, and high actually concern a relatively small part of the market, but this was to already be a bit more specific to the market on what we were aiming at on this SRP part of the criteria. The second part, more concretely, is concerning the criteria concerning the complex business model. So here we've been very specific on the type of activities where we consider it's clearly not possible to apply proportionality measures. So it only concerns actually 3 types of activities which are for us no-go, which are quite specific to the French market actually. Construction general liability and construction defect liability, which again does not concern a large number of undertakings, but is a very specific long-term market for construction on the French market. Medical professional liability, which was also a very specific long-term market, and insurance for credit rating upgrade, which is also something a bit of a niche market done by only a few undertakings. So basically, we've been very clear on the fact that these activities, even if you meet the criteria, you cannot ask for proportionality measures, whatever the other items are. So these are the, let's say, deterministic one concerning the complex business model. Then we also have a set of factors which are to be considered in determining whether the entity is eligible for proportionality measures, and which are the ones where we're going to look a bit more in detail. So it's mostly if there is reinsurance business, if there are international activities, ownership of complex activities, potential presence of an internal model or of USPs, use of outsourcing, or professional liability insurance covering long-term commitments. So clearly, it does not mean that if you meet one of these items, so if you have a part of international activity, we are necessarily going to say no. On the contrary, this is just part of a general analysis that we need to take into account consistently with what's provided for in the legislation to know whether we have a complex business model. On the contrary, if you're a company which does not do cross-border business, which does not do reinsurance, which does not have USPs, and that's the case of a large number of undertakings, then you can basically consider that on that front, the proportionality measures can be directly applied. The last point is concerning the last set of criteria, which concern the material concerns concerning the governance. So that's also a criteria that we need to take into account. And here again, I'm putting not exhaustive because again, we want to keep a bit of flexibility for expert judgment. But again, we say, okay, if you've had what we call administrative policy measures or disciplinary sanction or governance capital add-ons, then you're not going to be eligible for proportionality measures. Again, on our 300 undertakings, it only concerns a very limited number of undertakings. So again, this is not going to be largely discriminatory for many undertakings, but it's just to make clear to undertakings which are concerned by this type of measures that they will not be eligible for proportionality measures. We will also, more as part of the various part of expert judgment, look at fit and proper, and also if we have governance concerns following on-site inspections. So this was just to give you a flavor, and we've been a lot more detailed in terms of what we've been explaining to our market, but just to give you a flavor of where we have put emphasis on some of the criteria to assess the request for proportionality measures from non-SNCs. So just kind of as a recap, what has been our timeline. Our timeline. So as I was saying already back in October, we had a webinar on the new proportionality regime, which drew 500 participants, and which was followed by a survey. So that's the survey I was mentioning, where you had about half of the market answering and telling us what they were planning to do at that stage. Then internally, we worked on our procedures and criteria. So that required, if we wanted to make sure the retro planning worked, that required us to be ready internally already by beginning of 26. So basically, by beginning of 26, we had all our criteria set. We went to our board to make sure they were comfortable with it, and then also taking into account the technical specification provided by EIOPA, which were fortunately published in April. We managed to have a very good discussion with industry associations from April to June on what we intended to do, which means that we are confidently looking to publication of all the instructions and guidance in July. We have an internal consultation committee with the industry, which took place last week and which already cleared it, and now it needs to be cleared by our board. So that's going to be published in July. And then what we intend to do is to have a submission of dry run implications. So what we will do, and I will be a bit more specific on that, is that we're going to ask our market to submit in advance their application, so it can trigger discussions between undertakings and their supervisors. Again, it's dry run, so it's not the full set, and it doesn't have to be entirely validated by governance, but it's really and in full consistent with what EIOPA is usually recommending concerning the SRP, to make sure that we have a proper dialogue with undertakings ahead of the formal submission, because the formal submission will come on as of January 30, as was explained. We only have 4 months to answer at the beginning. So this is going to go really fast, because we were going to have to handle potentially around 300 applications in 4 months. So if we can already try to clarify things ahead of the dry run application, we hope it's going to be helpful for everybody. So what are these dry run applications going to consist of? And this will be my last remark. We give the possibility for undertakings on the French market to prepare the implementation by already submitting a dry run application. So it's basically the file that we've asked for and which is consistent with what's in the RTS, of course, in our instructions. Part of it, there are some small parts which cannot be included. This exercise is addressed to non-SNCs. Because SNCs, as was explained this morning, the criteria are much more automatic. They really mostly relate to quantitative criterion. So there it's much, there's less of a need for dialogue on a specific file, since we are more in a framework of notification by the undertakings, if they respect the quantitative criteria. Of course, we're also telling our market that potential SNCs are naturally able to exchange, and we also exchange with industry association to make sure, especially for those undertakings where some criteria might be on the limit, to be able to exchange, whether at the end of the day they're going to end on the SNC side or on the non-SNC side. So, but let's say the dry run exercise is focused mostly on non-SNCs. And the objective is to improve the completeness of application for the formal proportionality measures. So make sure that what they will submit in January, we will not have problem in terms of application being incomplete, of some things missing, etc. So we can already discuss that in advance. And also, based on the criteria I just set out and the others that have been clarified with the industry, to alert undertakings and groups if there are potential obstacles to obtain proportionality measures. So we want to make sure that either this can be addressed or that they know in advance that they will not be able to apply, so that they can prepare accordingly. We really want to manage expectations as much as possible, so that the undertakings know in advance what's going to happen to them, and make sure that they can plan accordingly. So to conclude, I mean, we've had a very constructive work with the French industry, and we want to thank industrial associations for that, which has enabled us to move forward on this. I must also say that our supervisory staff at ACPR is also quite excited to implement this new framework. I mean, we have lots of internal work. It's involving a lot of people, and it's a good project to kind of mobilize everybody, because of course all our supervisory units have undertakings which are concerned. So yeah, we're also happy to and excited to make sure this can be a success. I mean, we strongly believe at ICPR that good regulation can only matters if it can be put in practice. So we will make sure that the proportionality regime is working for the French market, and we will also keep on contributing actively to European discussions to make sure that this is also the case at European level. Thank you very much.
Thanks a lot, David. And it was, as expected, a very concrete example on how the conditions can be further implemented at national level, and it will be a very important work for the next years. Now, as anticipated, we can still allow for the Q&A session. I would still like to address to Johannes one question on the small and complex undertaking, which I believe it's still important to highlight. And the question is related to the reference date for the criteria, meaning for the initial application, for the initial notification period, which reference year shall be taken into account, whether end 2026 or end 2025.
Thank you, Jacopo. And I already gave a quick reply in the chat. However, I can now also extend orally. And so the directive says clear that to become SNCU, you need to comply over the last 2 available financial years. So this, or like if we don't consider like Solvency II or like deadlines for reporting, this would somehow naturally lead to 26 and 25. However, as the framework enters into application in January 2027, so there might not yet be the annual reporting for 2026 available. So we would therefore really encourage to check with your relevant supervisor what are the expectations in this regard, if the application can rely on the last 2 years that are already available at when you submit the application, and if there is some kind of after or like follow up when the 2026 data is available. So this really is an individual decision and depends on. Therefore, we would encourage like the dialogue with the supervisory authorities.
Thanks a lot, Johannes, on this. Then still looking at the question, I'm now referring to a question. I jump back to the undertakings that do not classify as small and complex. It's a question that pertains the size criterion. So as mentioned before, in the delegated regulation for all proportionality measures, all undertakings that are considered to be large with clear quantitative thresholds are prevented from applying. So given that they do not fulfill the conditions, supervisors will not grant the proportionality measures. The question relates the fact that it is requested whether this condition needs to be assessed by the insurer or is part of the application process, and therefore it will be the national competent authority to provide an answer. And then we have some sub-questions. If the assessment, in case the assessment is bared by the insurer, whether the reference to the technical provisions refers to the Solvency II technical provisions, and how it will be possible to assess the relative threshold, the threshold related to the market concentration. Now, regarding the first point, as I said, the conditions are there, and therefore undertakings that do not fulfill the conditions are not expected to apply to the supervisors, because they need to prove the supervisors that they meet all the conditions. And therefore, it should be the insurer that is aware of the amount of technical provisions or gross written premiums in absolute terms. Regarding the technical provisions, they correspond to the Solvency II technical provisions, and we don't have technical specifications on the level 2 on the delegated regulation, but you can also refer to the QRT data that are in the technical specifications with regard to the small and non-complex criteria for life technical provision and non-life gross written premium. Regarding the market level figures, of course, you can refer to the national statistics and possibly rely on the supervisory dialogue, and therefore engage with the supervisors on this. I would also have one question, I believe, that can be addressed to David. Sorry, I'm looking at it. Okay, so one question relates the premium threshold for insurers with the medical professional liability. It is asked what is the premium threshold that would exclude those insurers from applying for proportionality measures.
Okay, thank you, Jacopo. So, I mean, typically that's one of the examples where we've been specific in our the guidance we are going to publish and that we've already consulted with the industry. I didn't go into all the details this morning. So the threshold level is 60 million euro premiums in medical professional liability. Again, that applies to French licensed insurers. So if you're doing medical professional liability on the French market in cross-border, but you're licensed elsewhere in Europe, of course, it's your home NCAs which will determine your eligibility to a proportionality measure. So this concerns the French insurers which do medical professional liability, and the premium threshold is 60 million euros.
Thanks a lot, David. I believe it's very clear from our side. So I believe we have still time for one last question, and then we can allow for a few minutes for some closing remarks. I would actually address one question to Giovanni. The question says basically that is the ACPR approach to determining the proportionality measures applicable to non-small and complex groups intended to be a model for other supervisory authorities in other member states we followed, or are these supervisory authorities expected to develop their own approaches?
Thank you, and also thanks for the questions. Definitely, let's say that the insightful presentation from David and from on CPR process and practice can be an inspiring process model also for the other supervisory authorities. We invited Luciano and David to share their practice, to give a concrete example of the process that national supervisory authorities are implementing and concretely. And But of course, we expect other supervisory authority to tailor the process considering the specificities of their internal administrative processes, procedure. There is a strong link to the outcome of the supervisory review process. There are also, I would say, national specificities, contracts. So I think the process anyway should be tailored to the specificities. So I would encourage anyway to keep an open dialogue with your national supervisory authorities.
Thanks a lot, Giovanni. I think we can close now the part of the Q&A session. I wanted to first remind the fact that the event has been recorded. The recordings will be available online on the EIOPA event page in the next days. We need to allow the colleagues to complete some technical aspects, and then the recording will be online, and possibly also with the presentations. We also remind the fact that you submitted many questions. We tried to do our best to address all of them. They will not be forgotten. We will try to follow up one way or another, also via internal work. So it's they were really precious and stimulated the discussion today. I would then give again the floor back to you, Giovanni, for some final remarks. And I will also ask you to bear with us. After the end, we will project a QR code where you can complete, fill in a questionnaire on the event today, and it will be very important for us to, in order to better prepare future events on this regard.
Okay, thank you, Jacopo. Maybe in the time being, you can also share the QR code because it's very important for us to receive your feedback. But let me also thank all the speakers that intervened today. So Damian, Mark, Johannes, Luciano, Jacopo, Sebastiano, and David for the very insightful, valuable contribution. My thanks also go to all participants. I see that we reached almost 1,000 participants, so that was very encouraging for us that we spent quite a number of time and resources to organize this public event. We know that we have participants across the industry from many member states. So I want to thank you also for your active engagement. We haven't heard you, but I can reassure that we received, as Jacopo said, quite a lot of